Hi everyone, I'm Caroline Zakari and I work in the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to Financial Literacy Month. Today's program is called Investing Basics and is brought to you by the Securities and Exchange Commission and the Los Angeles Public Library. Today, Carol Lally from the SEC will be talking about investing strategies, including information on common scams, investment fraud, and cryptocurrencies. We'll have a brief Q&A after the presentation, so please send us your questions throughout the program. Thank you, and take it away, Carol.
Thank you. Good afternoon, everyone. Thank you, Caroline, and thank you for inviting me to speak today. I hope everybody's having a good week so far. As Caroline talked about, we are going to talk about investing basics, investing strategies, how to avoid fraud, how to reach out to the SEC if you need help. I have a PowerPoint presentation that I'm going to share, and then hopefully time and technology allowing, we're going to walk through some of the SEC's websites where you can find a lot of useful information, and then I'll take some questions at the end. I am going to take myself off camera during the presentation just because I find that a little distracting. And I'm happy to answer questions. I find it's usually helpful to hold those to the end. So whether you have questions you want to communicate in the chat or what have you, I will be sure to get to them when we get to the end. So without further ado, let me get my PowerPoint presentation up so you can see it. Okay, hopefully everyone can see that, and I'll take myself off camera while we start talking about investing basics and building wealth. So before we get too far in, I just have to give this caution that I have to give at the beginning of all of the presentations, and that is basically that I can't give legal or business advice. So this is not a statement of official SEC policy. It's not legal advice. It's not investment advice, and I can't provide those things. But hopefully what will happen today is you'll get some useful information about the securities market, how to plan for yourself and your future, and what to do if you run into problems. We're going to talk about the SEC generally, just give you some basic information about the Securities and Exchange Commission if you're not familiar with our agency, the basics of credit, how to build wealth through saving and investing, and how those two things are different. We're going to talk about technology and investing, and in particular, we're going to talk about the crypto market and how to plan for retirement, and finally, some tips on how to avoid fraud. Just a little bit of background on my own career and expertise. I have worked with the Securities and Exchange Commission for over 20 years. I am an attorney. I worked in the Division of Enforcement for about 10 years of my career, which means I investigated and prosecuted some of the kinds of fraud that we're going to talk about today. So I'm very familiar with how those investigations work. Now I oversee the part of the Los Angeles office that conducts investor outreach, like we're doing here today. And that also liaisons with the community generally, other federal agencies, state agencies, takes in tips and complaints from the public, and helps my office identify which of those tips and complaints are appropriate for further investigation or examination. Towards the end of the presentation, I will explain how you can submit a tip or complaint and what our process is for evaluating those. So let's dive into the SEC. Pretty much everything that I talk about today, you can find on the SEC's website, investor.gov. This is the website that is designed for what is sometimes called mom and pop or Main Street or retail investors, all of which just means ordinary people like you and me who are participating in the stock market. Not big hedge funds or entities like that, but ordinary people. And there's just a lot of really useful information here, as you can probably see just from the PowerPoint slide of the website's landing page. So hopefully we will have time at the end to walk through this, and I can show you a little bit more about how the website is set up. But even if we don't get a chance to do that, or if we do get a chance to do that, I really hope after some point after the presentation today, you go on yourself and check this out because it's really quite helpful. So the SEC itself has a three-part mission: to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation. We have rulemaking responsibilities, like a lot of federal agencies. We review the disclosures of public companies. We examine registrants like broker-dealers and investment advisors. But probably most people, when they think of the SEC, if they don't think about the football conference, what they think about is our enforcement division, which is the division that investigates and prosecutes violations of the federal securities law. So as you can see there on the screen, for the most recent year for which I have data, which was fiscal year 2021, our agency collected almost $4 billion as a result of almost 700 enforcement actions, and we paid out about $564 million to whistleblowers who provided original, timely, and credible information that led to a successful enforcement action. So a lot of times people ask me, why doesn't the SEC put so-and-so people in jail who are bad guys? And much as I would love to put bad guys in jail, we are not actually a criminal agency. We are a civil agency. But our Division of Enforcement does have very broad enforcement powers. We can go in and seize control of entities that have been taken over by bad guys. We can bar the bad guys from working in the securities industry. We can get funds repatriated from overseas. We can get disgorgement paid to harmed investors. We can impose financial penalties on the bad guys. And we do actually very frequently work in parallel with criminal enforcement agencies who will have their own separate enforcement action. So I would say maybe roughly 75% of the time when I brought an enforcement action in federal civil court or in a federal administrative forum, the criminal authorities brought their own criminal enforcement action in criminal court. And so very often the SEC would go in, seize control of the funds, try to get money back to harmed investors, and meanwhile the criminal authorities would try to send, and I think in all the cases that I worked on that had a criminal component, did in fact send the bad guys to prison. So there is frequently a criminal, parallel criminal action, but it's not brought by the SEC. Our whistleblower program, which hopefully we'll have a chance to talk about a little bit more, is something that people, if you have information and you submit as a whistleblower, that can provide you with confidentiality. It can provide you with the potential ability to get a monetary reward if you provide original information that's timely and that's credible that leads to a successful enforcement action. We are a mid-sized federal agencies, but the size of the industry and the market that we regulate is really quite large. The United States right now is the most successful, largest capital market in the history of the world, and has been really for the lifetimes of all the people participating in this call and presentation. And so it's really something that this country can and should be proud of, because it fuels the economic success of not just American companies, but ordinary Americans and our overall economy. As you can see from the slide, the size of the market is just huge. Not millions, not billions, but trillions of dollars. And many, many, many American families hold securities, even if you might not really have thought about it and realize that if you have some kind of retirement investing account, more than likely you hold securities in some form. Before we dive into investing though, since this is the basics of investing, I do want to take a step back a little bit and talk about some general personal financial planning information you should be thinking about and the basics of credit. So hopefully, as everybody participating in this presentation knows, it's really important to establish a credit record and to keep tabs on the credit record so that you make sure you have a good credit record and can incur, when needed, a responsible amount of debt and that you pay down that debt. Kind of ironically, in order to show that you are worthy of, to the banks or whatever lenders, that you're worthy of establishing a line of credit through a loan or something like that, you need to actually incur some debt. But the goal is to incur only so much debt as is reasonable for you and to pay that debt down responsibly, on time, or even early. And by incurring that debt, you then establish a credit record and hopefully improve your credit score by showing what a responsible borrower you are. So that credit, the ideal credit debit relationship is exactly what you see on the screen. Incurring a responsible amount of debt, paying it as you should, establishing a good credit record. And by doing that, then you are able to put yourself in a position to obtain loans when you need to for maybe some higher level purchases like a home or paying for college education or something along those lines. As the screen says, if you've got high interest debt, you really need to think about what your options are to try to pay that down as quickly as possible, because you can't really get the full benefit of investing, which we'll talk about in a moment, if you aren't managing your debt well. Understand that credit is expensive. So what may seem like a great deal on the front end, you're going to have, take some kind of line of credit, whether it's to buy something like a laptop or a loan to buy a car on the front end. And the monthly payments then are much smaller and more manageable than perhaps paying it in front, all up front. Over the long haul, that cost of credit is really quite expensive because interest is paid on those loans. So as you can see the example on the screen, if you had bought a laptop in the year 2022 and paid roughly $2,000 for it, if you pay it all up front, that laptop costs you $2,000. But if you obtain some kind of line of credit, whether it's a loan or what have you, in order to pay for that laptop, and instead of paying it all up front, you just pay $50 a month. That might sound great at the time, but over the life of paying that $2,000 at just $50 a month, the laptop is actually going to be quite a bit more expensive, $2,850 in this example. So really adding a significant amount to the price of the laptop. That's why it's so important to understand the cost of credit and to be very careful about incurring debt, particularly high interest debt like credit cards. If you have some questions about how you can improve your credit, these guidelines might help. Make sure to pay your bills on time every time. Try not to get close to the credit limit that you might have on a line of credit. Only apply for the credit that you need, and make sure that the information on your credit report is accurate. So that's just some basics about credit and establishing a good credit history. What we're really going to talk about today, though, is building wealth through saving and investing. So smart money management begins with saving. Saving is important for short-term emergencies, just general family goals, large purchases, maybe furniture or something along those lines. So saving is something that you definitely want to engage in for those ordinary life expenses and unplanned emergencies, like maybe medical expenses or things along those lines. In order to accomplish those goals, it's a great idea to have some kind of emergency fund, maybe 3 to 6 months of living expenses if possible, set aside, maybe fund that through one-time opportunities. I filed my taxes today. I hope everybody filed their taxes. And maybe you're in the fortunate position of getting a tax refund, or you've gotten some kind of gift money. You might want to take advantage of those one-time opportunities and put that money in your emergency fund. Another way to fund the emergency fund is to save automatically, such as by setting up a direct deposit to a savings or separate kind of account with each paycheck, so you have that emergency fund. But those savings are not the same thing as investing. Saving is typically money placed in some sort of low risk, meaning federally insured product, like a federally insured bank account, like a savings account. And it's generally used for more short-term goals, like, as I said, maybe a furniture purchase or an emergency fund to cover unexpected expenses, or if you had a break in your earnings and you needed funds to cover your day-to-day living expenses. That's savings. Investing is money that is placed at a higher risk. And the reason you would place it at a higher risk, which generally sounds like kind of a bad thing, why would you want your money to be at risk, is that you would have the possibility for a greater return over time, a rate of return that would outpace what is in a federally insured savings account. And the goal for that kind of financial planning is much more long-term than saving. Now we're talking about a long-term goal like retirement or maybe college expenses or something along those lines. Why are you putting your money at risk? Why can't you just all put it into something like an insured savings account? And the answer is interest. The interest that is paid and inflation, because the interest that is paid on your federally insured savings account is not going to keep up with inflation, even when we're in a low inflation market. So let's take the example of a car. In 1997, if you wanted to buy a Ford Mustang convertible, apparently it would be around $24,000. But if you had said, okay, 25 years from now, roughly, I'm going to buy this car. I've got $24,000. I'm just going to stick it in a savings somewhere thereabout. I'm just going to stick it in a savings account and hang on to it, and I'll buy that car in 25 years. $24,000 wouldn't get you a Mustang today. Price of that car is now much closer to $50,000. So that's almost 100% increase in the price of the car over 25 years. And regular interest does not keep up with that, such as you might earn in a savings account at the bank. That's why investing is important for long-term financial planning. As hopefully everybody knows, when money is invested, it grows through compound interest, what's been called the eighth wonder of the world. So you put money in some kind of investment, hopefully it earns a positive return, and then you have both the original funds that you placed in the investment plus the interest that you have earned, and both of those pools are now earning interest. So kind of like a snowball rolling downhill as it picks up more and more snow, it gets bigger. As you put your money into investments, if that money earns a positive interest, then that interest also has the potential to earn positive interest, not just the principal that you originally invested. And you can grow those funds through investing in stocks or bonds or funds that hold a variety of securities, including some combination potentially of stocks and or bonds or similar sorts of products. This next slide really shows how compounding interest works. So let's say you have $100 a month that you are contributing to some kind of saving or investing account over your really adult life for 40 years. And during that time, you could earn a 7% annual return if you invested it in something like an investment. That's the red line that we're showing there, that stocks, bonds, or some sort of investment fund. If you put that money into an investment account and we assume an average, that doesn't mean every year earns 7%, but an average over 40 years of a 7% return, at the end of 40 years, you'll see your $100 a month has turned into almost $240,000. Some years are going to be up, some years are going to be down, but 7 to 9% is actually the average annual return of the modern U.S. stock market, going back to the Great Depression at the beginning of the last century. If you just put that money in a regular account under your mattress, not earning interest, over the course of 40 years, that $100 a month is just $48,000. So the difference in the value is significant. And you can really see it takes off about midway through year 20. And that's why time is really your friend. That's when you're accumulating so much interest on the interest that the amount of the money, $240,000 that comes out of your pocket, is proportionally really quite small. $100 a month, $48,000 over the life of 40 years. The amount that's coming out of your pocket is really pretty small compared to the ultimate return that you're getting of $240,000, because most of your growth has come from interest earned on interest. That's why it's so important to think about investing as part of your financial planning and really take advantage of the wonder of compound interest. As I said, over the life of the modern U.S. stock market, the average returns have been 7 to 9%. Does that mean that every year has been in this range of 7 to 9%? No, there are going to be downturns in the market. Just as we can see on the slide on the screen, over the last 30 years, there have been some definite downturns, like in the recession. But then there have also been some definite up years where the market has outperformed 7 to 9%. But overall, the long-term trend going all the way back to the Great Depression is positive. That's why it's so important to understand what your own financial window is as well. Do you have a long time until you're going to need that money? Are you at the start of your investing journey and you won't need those funds for maybe 20 to 30 years? or you're getting close to the point where you will need those funds. And that really feeds into how much risk you can take on in your investing, which we will talk about. So again, the power of starting early, really important. The earlier you start, the less money you need to reach your goals. Let's say you want to have $500,000 set aside by the time you're 65. If you start investing at age 25, again, assuming this 7% annual rate of return, you can reach that goal with $209 a month out of your pocket. But if you don't start investing until much later, say age 55, a whole lot more of that money is going to have to come out of your pocket, about $3,000 a month, because you don't have time to accumulate enough interest on the interest to really get the full benefit of compound interest the way you would if you were 25 years old. That's not to say, you shouldn't start investing at 55. It's just to say that more of the funds are going to have to come out of your pocket. So a really simple way to accomplish this is to automate your saving and investing. Sit down, work out your budget of your fixed expenses, your expenses that maybe you can increase or decrease depending on your financial situation. Figure out what those are, and then make sure you include in that budget some amount of money that you're setting aside for saving and investing. And best of all is if you can automate that. Say $75 a month, every month out of your paycheck, going into some sort of account, whether it's saving or investing or a combination of the two. You just kind of set it and forget it. Although I don't mean forget it completely, you do want to keep an eye on what's happening with those funds, but make that a habit that just sticks for 20, 30, 40 years, then that money will accumulate and interest on the interest will accumulate. So I said earlier, one of the key features of investments is that they have risk. That's what differentiates investing from saving. All investments have risk. That's just a feature of investments, the same way, gravity is a feature of existing on this planet. Investments have risk. So if you ever somebody tries to sell you an investment where they say this investment is risk-free, that's a huge red flag. The nature of investments is that they have risk. And it's the potential for risk that leads to the potential for reward. But it is still risk, including the risk of loss of all of your investment funds. So knowing that, it's important to understand how you can manage risk. And there are two basic steps that investors use to manage risk. One is asset allocation and one is diversification. And I'm going to explain what each of those terms mean. But basically, there are two ways of avoiding putting all of your eggs in one basket. Stepping back just a minute, what are the kinds of things you could invest in? So there are three traditional categories of investing: cash and cash-like products, bonds, and stocks. So by cash, I mean not just things like dollar bills, but also savings accounts, checking accounts, CDs, money market accounts. These things have lower risk. They might be insured. Money might be placed in things that is really relatively safe, but they're going to have the potential for the lowest returns. Bonds are like loans. So governments or municipalities, corporations take loans, and bonds are the way of funding those loans. Those are more risky than cash, but have the potential for higher returns, typically. And then the highest risk traditional category is stocks, which are shares of ownership in some kind of company, usually. And they have the highest risk because the company might go bankrupt, could be successful for a long time, or then maybe its business model starts to falter, and the company loses value, the stocks lose value. So they have the highest risk, but they also have the potential for the highest returns. You invest in a company in the early stages, it turns out to be very successful, makes a lot of money, maybe changes the market in a really fundamental way. And so you can really get a high return in those sorts of situations. Potential, the key word is potential for the highest return, but it comes with the highest risk. Likewise, you can invest in funds that hold bonds or that hold stocks. So those are the three traditional categories of investment products. Asset allocation, and I apologize, there's a little typo on the slide. I don't make the slides do, but the DC does. But the asset allocation means dividing an investment portfolio among different asset categories such as stocks, bonds, and cash. So looking at the pie graph on the left-hand side, the red piece of the pie might be stocks, the green piece might be bonds, the blue piece might be cash. So you're dividing your funds through all of these three traditional categories that we just talked about. One that's lower risk like cash, one that's a little higher risk like bonds, and one that maybe is the highest risk like stocks. It's important to know, as I said, what your time horizon is. And that really, for a lot of us, informs our risk tolerance. Because if you have a long period of time until you need those funds, you're probably in a better position to take on more risk. Because when the inevitable downturns happen, you have the time to ride those out until we get back to the good times and the stock market is performing well again, because there will be those downturns. Whereas if you are much closer to needing those funds, if you're going to retire, let's say in the next 2 or 3 years, you probably really don't have a lot of risk tolerance because you don't have time to make up for any losses should the market have a downturn, say, tomorrow, because it takes a certain amount of time for the market to recover. So you may be much less likely to be in a position to take on more risk because you don't have the time to earn additional funds or to recover from those losses. So really knowing your time horizon is really, really important. So for example, if I were looking at my stock category, then within asset allocation, you would consider also diversification. So for example, you've allocated your assets. You've put some money in stocks, some in bonds, some in cash-like products. But within those categories, you're going to divide again further. So within stocks, you want to make sure, or you want to at least think about investing across the market. Oh, I'm sorry. So unfortunately, these slides, as I say, are not created by me. But let's imagine the pie graph has a name for each of the pieces of pie in that green pie. So one might be pharma, one might be tech, one might be manufacturing. Within stocks, you would look to, if you're thinking of diversifying, you would look to hold stocks not just in one particular segment of the market, not just in pharma or tech. You wouldn't want to hold stocks necessarily in just US or foreign companies. Maybe you wouldn't want to have stocks just in small or large companies. You might want to think about having stocks over many different segments of the market, many different sizes of companies, and many different, maybe more than just US stocks, maybe also international stocks. So maybe this is a better slide that DC has put together on diversification. What might diversification look like? So the snapshot that we have right in front of you is a snapshot of all 500 stocks that are tracked by the S&P 500. So each square has within it a ticker symbol of one of the stocks that the S&P 500 tracks. And then it's divided by categories of the market. So you can see in the top left hand of the screen, there's the technology sector of the market. You can see the stock symbol for Microsoft, MSFT, and underneath that, Apple, AAPL. Towards the bottom right-hand side of the screen, you can see basic materials, and above that, utilities and energy and real estate. So one way to diversify, and this is not legal or financial advice, just an example, might be to try to hold all 500 stocks in the S&P 500. So if any segment of the market is having a down day, and you can see on this slide the segments of the market that are having a down day by red. So on this particular day, technology, consumer electronics, communication services were having down days. Those stocks were losing money. But at the same time, there are some stocks and some segments of the market that are having a good day. So if you see squares that are in green and those ticker symbols in a green box, those are stocks that are making money. So right below consumer electronics, you can see financial. Those stocks are having a good day. Banks, having a good day, earning money. You can see the ticker symbol for JP Morgan, Bank of America, Citibank. If the stock is sort of a gray color, that means it's about breaking even. But overall, and this is a snapshot of actually a particular trading day, overall there's more green on the screen than there is red. Some of the boxes are a little larger, but overall, more of the boxes are green than red. So that would be the idea of trying to follow the S&P 500, that you would be diversified enough that any segment of the market that's not performing well is hopefully balanced out or even outperformed by the segments of the market that are doing better. One way to diversify by following the S&P 500 might be to go out and buy shares in all 500 of these companies. And that's certainly something that you can do. But it does tend to be time consuming if you're doing it right, because you want to research the companies, you want to figure out how much of each segment of the market you want to be in. Do you want more shares of a utility company than you do of a healthcare company? And you have to follow and track these shares and make adjustments over time as maybe you want to rebalance your portfolio. You've got to pay commissions every time you buy and sell these individual stocks. So it's certainly something that you can do. But another way to approach it and to get the same diversification might be to invest in a mutual fund that tracks the S&P 500. And this would accomplish the same goals for you. You would still hold all 500 shares of all 500 of these companies, but you would hold them through buying shares in a mutual fund instead of having to buy the individual shares in each company. That's why mutual funds and exchange traded funds are such a popular type of investment with so many individual investors. They get you this diversification, they're professionally managed, they tend to be affordable, the fees tend to be relatively low. They do have risk because, as I said, all investments have risk, but they're going to have typically the same risk as the underlying securities. You can even find funds that have target dates. These are called target date or life cycle funds. And that target date refers usually to the date when you are anticipating that you might need that money. So if you are thinking you're going to retire in 2050, you can probably find a retirement or target fund that targets exactly that year, 2050. And it rebalances each year as you get closer, or each quarter, or however often the prospectus tells you they're going to rebalance it. They will rebalance periodically as you get closer to that retirement date. So you can see we have a comparison here on the screen of one where somebody's not retiring until 2050, and one where somebody's retiring much sooner in 2030. And you can see the fund with a later retirement date has riskier investments in it because they have more time to recoup any losses, whereas the target date that's approaching more quickly, probably that's going to be rebalanced to be a little bit more conservative with things in lower risk investments. If you are new to investing, you want to be sure you are really careful where you get your investment information. So particularly, like most things, whether you're buying a car or investing or finding a friend, whatever you're doing on the internet, you really want to be very careful about getting your information from the internet. Sure, there's good information on the internet, but there's a lot of bad information too. And just because something's been endorsed by a celebrity or somebody that you trust, or on a social media feed that you trust, you still need to be cautious, because the people that you trust may themselves not have the complete information. They may have been duped without knowing it, and their situation is never going to be exactly the same as yours. So you just want to make sure that you do your own research. Investing isn't a get-rich-quick scheme. It is something that takes time and consistency. So you want to play the long game and be really thoughtful in your choices. Let's talk a little bit more about the internet and technology and investing. Outside of the three main families of investments that I've discussed, stocks, bonds, cash-like investments, there's a whole world called alternative investments, which could be a lot of different things. It could be, very often is today, things that are crypto related. It might also be something like a commodity, or it could be something like an investing pool that a friend or coworker has asked you to participate in. The potential and advantages for alternative investments is that this gives you another opportunity for diversification, where not everything is all in the same basket, but there are a lot of risks in the alternative investment space. Sometimes these investments are limited to high net worth individuals. They tend to have fewer regulations. There tends to be less disclosure about what you're actually investing in. It can be difficult to sell the investment, and lots of times they're very confusing, and they may have high fees that are not immediately apparent to you. This category does include crypto type assets. If you're not familiar with cryptocurrency and investments like that, there's a lot of information about this on our investor.gov website, and I encourage you to go there if this is an area that you're interested in at all. But I would also encourage you to really proceed with caution, because all investments in this space are high risk. This is an emerging market that has not existed much more than a decade. So there's a limited track record of any kind of crypto entity. They're speculative because we don't know how this market is going to shake out. There are lots of media coverage about crypto related things, lots of crypto related companies, tokens, etc. But it's not entirely clear how the crypto assets and the underlying blockchain are going to be used to generate money. What is the there behind the blockchain technology? How is that blockchain technology ultimately going to be put to use to generate funds and generate an increase in value? At this point, it's really very speculative, and people might be trading just on movements in the market rather than the underlying fundamentals of the company, that the crypto company that they're investing in. So you need to be very, very cautious investing in this space. The assets are highly volatile. So we have, if you followed this at all in the media over the last few years, you have seen crypto assets skyrocket quickly in value and then plunge dramatically and also quickly in value, and then just go back and forth, as you can see by a representation on the screen of one of the most well-established crypto assets. The value, I think the screen is of Bitcoin, so something that people are probably familiar with at least a little bit. So this kind of signature, up and down volatile trading signature of the value of the assets is a very strong indicator that this is a really speculative market. And so you want to proceed with caution if you invest in this area. In addition, these crypto assets are very susceptible to market manipulation or other kinds of fraud. A lot of them are used very substantially in truly illegal activity, not just market manipulation, but terrorist financing, human trafficking, money laundering. They may not be secure, and they require a lot of substantial energy consumption, again, without always knowing how the cost of that energy consumption and the business model are going to be recouped by adding some sort of clear value. So just understand that there's a lot of risk in this area, and you can lose all of your money when investing in any asset, but particularly in risky assets. So if you do want to dip your toe into this end of the pool, just consider very carefully how much of your portfolio you want to expose to this level of risk. Likewise, if you use investing apps to buy or sell securities as opposed to a conventional broker, you want to make sure that your app is a registered investment firm, and you want to be really sure that you understand the fees or how the costs and commission work, because nothing in this world is free. Trust me, these companies are making money somehow. They want to get paid themselves. So if you're using an investing app, make sure you understand the risks of participating in the market via an app. And there's information about this on investor.gov. If you hope to make money by timing the market winners and losers, just understand this active trading strategy is not something that works out well for really hardly ever anybody, including people who are investing professionals. Generally speaking, for almost everybody, it results in underperforming the market. And individuals trying to pick individual stocks and time when to buy and sell them instead of having a long-term investing strategy generally results in losses for people, not least of which because if you miss even a few of the best performing days of any given time, then that will negatively impact your long-term returns much longer than just the course of a few days. That can have, because of the nature of compound interest, if you've missed out on those big return days, that can have a long-term impact on your investing dollars. Generally speaking, rapid and frequent selling results in more taxes. So that's a cost that you have to factor in as well. And this is why mutual funds and ETFs frequently make sense for a lot of individuals, because they provide this diversification and facilitate asset allocation. They simplify a long-term investing strategy, and they tend to be cheap. So compared to other investing. So now let's turn to just generally planning for retirement. Again, if you've got an opportunity to participate in a work-sponsored 401k or similar kind of plan, for a lot of us, this is really the best way to do some at least basic retirement planning. You can also open an IRA, which is an individual retirement account, which will allow you to invest in individual stocks and bonds, but also funds like mutual funds or ETFs. Retirement accounts can have tax advantages depending on which form of retirement account you invest in. You can pay the taxes now or you can pay the taxes later. The answer to which is the better investment is really going to depend on your individual situation and when you think your taxable income is going to be the highest. Lots of people choose to do a little bit of investing in both traditional and Roth IRAs. Don't delay. Make sure you take advantage of employer matching if you have it. Contribute consistently, and make sure you pay attention to fees, because lots of times the fees eat into people's returns in a way that they do not really anticipate because they haven't looked closely at the fees. If you have identified some mutual funds that you might be interested in investing in, I encourage you to go to FINRA's website. FINRA is the self-regulatory organization for broker-dealers, and it's overseen by the SEC. They have a tool on their website called the Fund Analyzer, and you can go in and put the names or ticker symbols of mutual funds and compare them side by side, including comparing their fees. So generally speaking, what we see at the SEC is individuals who end up in a good place for their retirement have several things in common. And it's not that they were aggressive or particularly creative traders, it's that they participated in an employer retirement sponsored retirement plan from the beginning of their career. They took advantage of employer matches. They contributed as much as they possibly could consistently over their whole entire career, and they used an investment strategy that was appropriate for their time horizon, probably becoming more conservative as they got closer to retirement. If you switch jobs, very often you can transfer your 401k to a new retirement plan at your new employer. You can roll over to an IRA. You can usually take a lump sum distribution, but you will owe taxes and pay a penalty if you take money out of your 401k or similar account before the age of 59 and a half. So now I want to talk quickly about avoiding fraud so I can make sure we leave time for some questions. Unfortunately, fraud is really, really prevalent. More than 80% of us will be solicited for potentially fraudulent investment offers. More than 10% of us will invest in a fraudulent offer, and pretty close to 10% of us will lose significant funds by participating in those offers. Over $50 billion a year is lost to fraud. So when people ask me who is likely to be a target of fraud, am I likely to be a target of fraud? The answer is everyone, and yes. So just be very cautious and think very carefully before you entrust your money to someone else. Red flags of investment fraud: unregistered and unlicensed sellers, promises of high returns with little to no risk, pressure to buy quickly. Some kind of social kind of contract very often is a red flag of investment fraud, such as if you go to a free meal seminar for some free investing advice, then you may feel some social pressure. Here's this nice person who's given you a nice lunch and provided you this free investment advice so nicely. I will, give this person a few $1,000s to invest as a reciprocation of this social situation. And it might be something like someone you know from church that maybe you feel some kind of social obligation to. Be very cautious of allowing those kinds of social situations or social pressure to encourage you to part with your funds. And do your research so you know if there are red flags in the individual or the company's background, and you can evaluate them. Ask questions, do your research, conduct a background search. That's what you should do each and every time you're investing. So I am going to come out of the PowerPoint and then I'm going to go hopefully into the internet so you can see it, because I think it's actually more helpful than looking at the slides. We'll actually go on the website itself and hopefully you can see it. So give me just a minute to switch over to the internet. Hopefully you'll be able to see. Okay, so hopefully everybody can see the website investor.gov. This is where, as I said, most of the information in this presentation comes. And there are a lot of drop-down tabs here where you can get information about crypto assets. You can get general information about fees or investment products, financial tools and calculators. If you scroll down just a little bit, you'll see this section that says Get Help, kind of on the right-hand side, where you can submit questions and complaints. So if you have a concern about an investment you've participated in, I would really encourage you to submit right here. It gets looked at immediately. We begin triaging it, and nothing that goes, it does not go into a black hole. They're dedicated staff of accountants and attorneys who review every tip that comes in. But let's say you've been approached by someone named Jordan Belfort, who purports to be a stockbroker or to give investing advice. The first thing you would want to do is go and put Mr. Belfort's name in this search engine right here on investor.gov. And Mr. Belfort actually is a real person. And as you can see, when we put his name in, he has been barred by the SEC or FINRA. I would want to know that before I gave my money to Jordan Belfort. I can click on get the full report, and up will pop more information about Mr. Belfort. Now, if I put in his name and he wasn't in here at all, that would be a big red flag. Because if you provide investment advice or you buy and sell securities on someone else's behalf for compensation, either a fee or a commission, then you need to be registered as a securities broker or an investment advisor, depending on whether you're engaged in trading or giving advice and how you're compensated. You need to be registered or licensed as one or the other. And if you are, you're going to be in this database. So the first red flag would be if they're not in here at all. But let's assume that they are, like Mr. Belfort. Then we're going to click on this detailed report and get more information about Mr. Belfort. First part of the report will explain how the information is gathered, and these reports are written for individual members of the public. So they tries to be as easy to read and understand as possible. The beginning part of it will talk about their employment history, the securities exam that they passed, when they worked and were registered at various broker-dealers or investment advisors. And then farther down, we'll get into the disclosure history. And this will be customer complaints, lawsuits, enforcement actions by government agencies. And for lots of individuals, there will be nothing in here. But in this particular case, we can see Mr. Belfort has been sued by the state of Michigan, he's been sued by the state of Maryland, and then he's been sued by the SEC. And he was ordered to pay $1.5 million in disgorgement plus prejudgment interest plus civil penalties and barred from working in the securities industry. And if you're a moviegoer or know about the securities industry, you may recognize the name Jordan Belfort. He was portrayed in the movie The Wolf of Wall Street by Leonardo DiCaprio. He's a real person. He ran a real investment scheme for many, many years, taking money from investors who, as part of a boiler room. I would want to know before I gave my money over to Jordan Belfort. So that is the first thing that you should do if you're investing with someone. If someone's giving you investment advice for money or buying and selling securities on your behalf, you want to go in here and see what information you can find out about them and if they're registered. The next thing you want to do is find out if the thing itself is registered. And I hope everybody can see this tab, sec.gov. That's our other website. It's a little more governmenty looking. But right here on the right-hand side, you can see company filings, or here's a drop down for filings. And this is where you would search the thing that you're investing in, the stock or whatever the form of the investment is. So let's say, for example, you were considering investing in the company Exxon. Simply go in here, pull up. You can see that this company and its securities are registered with the SEC. And here are all their most recent filings, 8K, 10Ks, all the kind of information you would want to read before you invested in the company, because this is going to tell you about the financial history and business model of the company. If somebody is selling you an investment that is not in this database, that is a big red flag, because there are very few exemptions and exclusions to being registered with the SEC. So you should be able to get this kind of record for the investment. If the company is in this database, then you want to read this material. And you may be saying to yourself, I do not know how to read a 10K or 10Q, and I don't really even know what that is. Fair enough. Right below this landing page, in what we call our Edgar database, dropping down from filings, there is information on how to research public companies. Or you could go to this drop-down menu, how to search Edgar or about Edgar. But we've got this guide right here, how to research public companies. And within the guide, you will see information on what is a 10K, what kind of information is in here, how do I read it, and all sorts of different forms that might be filed. So a lot of really useful information. So let me go back and stop sharing and get us back to our PowerPoint presentation. Okay, so hopefully everybody, can you see the PowerPoint? Okay, so these, I'm going to go quickly through these slides because they just explain basically what I just did. So you're going to want to check your investment professional and research, and the individual and the company, and then you're going to want to research the actual thing that you're investing in. You also want to be careful how you pay. Legitimate brokers aren't going to ask you to buy securities with a credit card. And if you have questions or concerns, again, go to investor.gov. Lots of really useful information, including investor alerts, such as alerts on crypto scams, characteristics of mutual funds, how to select an investing professional. And then here's information on how you can contact us. So there's an 800 number, a couple of email addresses. We're on Facebook. We're on what used to be called Twitter, and our websites. So hopefully that information is helpful. You know, it's a lot of information to digest in a short amount of time. So I'm going to stop talking, and I'm happy to take any questions that anybody might have.
I'm back, Carol. Okay, great presentation. I always learn a lot. I have to I'll always go back to investor.gov and all the websites you recommend because they're amazing. Okay, so we do have one question. Beruz has a question. How and where do you look up investors?
So individual investors. So
Yes.
you can't look up an investor in the sense that if you wanted to know, does your neighbor Jane Doe have shares of Exxon? That's not something that you can look up. But if you wanted to know who owns Exxon stock generally, you can go to sec.gov, look up the filings that Exxon has made, and you will get a sense of at least who the largest stockholders are. So there are, I don't know off the top of my head, but I'm guessing there are some large investment funds that have some significant ownership of Exxon. If you were looking at a much smaller, and that would be disclosed in their filings, like their 10Ks and their 10Qs. When insiders trade in stock, so lots of times if somebody is a CEO of a company, part of their compensation, they will be given shares of the company. There are restrictions on when they can trade those shares, but they are, under certain circumstances and at certain times, allowed to trade them. And so you would see information about how many shares of the company the CEO got, for example, and when he or she traded them. That information would be in there too. If we're talking about a smaller company, that information in many ways might be even more relevant, I would say, in my opinion, in those circumstances, because those companies do often tend to be a lot of the shares held by individuals. And so you might find that 75%, 90% of the shares that the company has issued are held by the insiders of the company. That might be really useful information for you if you're deciding whether or not to invest, because that means those people really control the company for all intents and purposes.
Wonderful. Thank you. And then there's also a follow-up question. Also, what is your best advice for gaining or deepening investment literacy?
Yeah, I would say the very first thing that I would do is go on investor.gov and really explore that website. And just there's a lot of information for beginning investors, basic information about the stock market and stock market fundamentals. I would not be allowed to, and I don't think I'm really the best person anyway to recommend any particular investment book. But I would say, my experience is something just really pretty general is often a better investment book than some individual
Mm,
personalities' investment book. I would be very careful about the cult of personality in the investing space. So, if you're really at the beginning, something like a basic class at a community college or the Idiot's Guide to Investing or something like that is probably a better place to start. And of course, your library probably has a lot of really useful information to you and for you. And if you go to the resource desk at the LA Public Library, I bet they can point you in a good direction
I was
too.
going to actually say that. So we have a financially, I'm going to mention that at the very end. We have a Financial Literacy Month webpage right now, LAPL. We can display it right now, lapl.org/ Financial Literacy Month. And we have like a book river on the bottom. So those are recommended books and circulation. I mean, great. We like, so it's a list of different books on different financial literacy topics. So bears, you might want to check that out as well. So those are like librarian recommended books. We
Yeah,
have
and I would
another,
just say generally, like that kind of
yeah,
source is probably far better than, Mr. Celebrity, whomever's guide to investing, because their incentives probably don't align with your incentives. Their incentives are to, you know, get a lot of people to give them money. Your incentive is to make good investing decisions that are tailored to you.
definitely. Yeah, we try to go with the reviews and all that. So yeah, definitely. We have a question from the Zaz family. How can we invest for minors? And is there a platform to invest under their name?
Well, this is going to steer into the realm of kind of investing advice that I cannot give. There may be some information about this on investor.gov, although I'm not sure, and probably the library has some good resources on
Mhm.
this as well. But what you see, what in my this is my personal experience as well as my professional experience, what you see very often is people setting up some form of trust, which sounds like
Mm,
a fancy thing that only rich people do,
mm,
but actually is something that ordinary people do a lot and will have some kind of trust on behalf of minors and will invest in there for them. I would, um, research that. Probably a good idea to get the help of a lawyer in setting that up, and a lawyer who would be familiar with the tax consequences as well. But it's not as expensive or as difficult as it might sound, and that is usually what people do. But I cannot give business or legal advice on it.
That's actually, my parents made us do that. I mean, years ago. So when we were kids, they started the trust, and like I had no idea at the time, like what are they doing? But yeah, so
Exactly.
you that
Exactly.
the trust is a great way
Yeah,
to.
and it's just something ordinary. Not, I mean, I'm sure millionaires and bajillionaires do that and much more, but ordinary people can do that too.
Most definitely. Thank you. And then we have, yes. So one more, well, actually, one more thing. How does the best way to contact the SEC?
Best
Carol,
way
let
to
us know.
contact us really is going through that portal on investor.gov and submitting something online through that portal. If you don't want to do that, if you're not a person who likes the internet, call us at our 800 number on the screen, 800-732-0330. Email us at help@sec.gov, and we will, send us a letter. We do that too.
Great. Thank you so much, Kelly. It's 1 o'clock now. Let me wrap it up. Thank you for a great presentation. If anyone missed any of this presentation, it will be available on LAPL's YouTube page shortly. The URL is youtube.com/Los Angeles Library. And then we have another streaming program coming up tomorrow. It's called Introduction to Financial Planning Basics with the Financial Planning Association of Los Angeles. It'll be 12 to 1 again, same place on our YouTube channel. And I wanted to remind everyone we also have 2 more Financial Literacy Day events coming up. The next one is this Saturday, April 20th from 10 a.m. to 1 p.m. at the Encino Tarzano branch. There will be a retirement planning workshop in the beginning at 10 a.m. and then from 11 to 1 there are one-on-one appointments with certified financial planners. So to make an appointment, you can give us a call at 213-228-7140. And for more information on all of our Financial Literacy Month programs and to look at the book river and everything, you can go to our website at lapl.org/Financial Literacy Month. I wanted to thank Carol again and everyone for tuning in, and have a great day, everyone. Thank you so much.
Thank
Bye-bye.
you. Bye.